morning, good afternoon, good evening, wherever you are in the world. I'm Nicolas Véron. It's my pleasure to introduce this session of the Financial Statements series at the Peterson Institute for International Economics. And today we're focusing on financial risk and the relationship between financial risk and policy decisions with a focus on the Eurozone in Europe. So we couldn't have a better duo to discuss this than Peter Praet and Guntram Wolff. I have to disclose from the start that I'm not entirely neutral here because Peter was very much involved in the creation of Bruegel, where I also work, and Guntram was the director of Bruegel for many years. But here we are. I think it shouldn't be an impediment for them to speak here because they're the best on this topic. Peter Praet studied at the Université Libre de Bruxelles, ULB. He got his PhD in economics there in 1980s and went on to work for 2 years at the International Monetary Fund in Washington, D.C. He was then a faculty at ULB, Université Libre de Bruxelles, until 1987. And then he was, for more than a decade, the chief economist for one of the largest banks in Belgium, which was then called Générale de Banque and then Fortis Bank. Until 1999. Then he went into politics for a period as chief of staff of Didier Reynders, who is now the Belgian European Commissioner. I mean, that's not an elected political position, but it's certainly ministerial. And then joined the National Bank of Belgium as an executive board member, where he stayed for more than a decade until 2011. At the National Bank of Belgium, Peter Praet was in charge of financial stability. He was actually one of the very first central banks after the Bank of England, I think, to initiate a financial stability review in the 2000s. He was also a member of the management committee of the Belgian Financial Supervisory Authority, which at the time was called CBFA, now FSMA. And in that capacity was in charge of SWIFT and a number of other important duties, and also a professor of monetary theory at the Solvay Business School at ULB University. In 2011, Peter Praet became a member of the executive board of the European Central Bank in Frankfurt. He was in charge of organization, human resource, and most importantly, from 2012, the chief economist of the ECB, the first non-German chief economist of the ECB, as it happened. And very much in charge of many ECB functions actually during the Eurozone crisis until his retirement from the ECB in 2019 at the end of his term. Since then, he's been a visiting fellow at the Solvay Business School. I mentioned his duties at Bruegel. He was in the board of Bruegel in the early years of that organization. And also last year, he led a review of the quality and impact of Bruegel's work over the last 3 years. Guntram Wolff studied at the University of Passau, at the Toulouse School of Economics, at the University of Pittsburgh, and at University of Bonn, where he got his PhD in 2004. He was also a fellow at the Center for European Integration Studies of the University of Bonn, known as ZEI for its German acronym. Then Guntram worked at the Bundesbank as an economist for a number of years and at the European Commission from 2008 to 2011 in the Directorate General for Economic and Monetary Affairs, DG ECFIN. He then joined Bruegel, as I mentioned, in 2011 as a senior fellow, deputy director, and from 2013, the director of the organization, which he left in August this year. Since August, Guntram has been the director of DGAP, the German Council on Foreign Relations, which is the leading foreign affairs think tanks in Berlin, but still very much an economist, and therefore we look forward to the conversation here. Peter, over to you. I will manage your slides if I can do that.
And thank you. Thank you for this nice presentation. Too long presentation, Nicolas. I will stick to the 10 minutes presentation. We have a few slides. I will go very quickly through. So basically, next slide, Nicolas. Basically, the outline. I will focus on monetary policy, and Guntram, you may say something on fiscal policy as well. But I think basically here it's the interaction between monetary policy and financial stability that I want to focus on. So I first will discuss very briefly the too low inflation environment in which I was when I was in the ECB. Basically, we had a problem of instruments. We had a zero lower bound. And but we didn't have this problem of inflationary pressures, and we had weak, too low inflation and too low aggregate demand in general. So our problems was to find the appropriate instruments. And so I will discuss very briefly, basically to discuss maybe what is the legacy of this period, because now we are in a very different context, which I would qualify not an inflationary context, but stagflationary context. I talk about stagflationary pressures because we are not in stagflation, but we have pressures. Basically inflation is very high, and we have downwards pressure on growth, which is a very uncomfortable situation for the central bank. And then I will discuss, the options for monetary policy looking forward. So Nicolas, the next one. So in the too low inflation environment, we had two big events of financial instability. As you know, it's the global banking, the banking crisis in Europe and the euro crisis. We had, very severe financial instability. Basically, we were not prepared in Europe. So that's a very important point for the future. And we are going to discuss that. Are we better prepared? We had a huge shock with the COVID shock, and we didn't have really financial instability episodes. And that's worth discussing. Is it because of framework, financial stability framework is better? It's because, governments in general, authorities reacted so strongly because they were really afraid, given the experience that we had, after 2008. And maybe some people would argue they overreacted. And one indicator, for example, of possible overreaction is that we had a very severe shock, but the number of bankruptcies really collapsed during this shock. I never saw that in all my life experience, that when the economy is subject to such a big shock, that the bankruptcies go down in place of going up. And so I think that's very important to have that in mind. So we had financial instability episodes, very severe ones. We changed very much, improved very much the institutional framework of crisis management, like in banking. There have been many reforms, also in banking resolution, but there are still today important gaps. And I think that's an important discussion. How confident are we in the framework, to manage, probably the present shock and what's going to come? We also, I think it's also in the past, we had this tendency to overburden the central bank, maybe because we were not prepared for crisis. So one easy way is to ask the central bank to intervene. And as I said before, very briefly, in all my period, the most concern we had in monetary policy was to stimulate the risk channel in monetary policy. So basically, we found a number of ways of doing that. Basically, it was a combination of asset purchases, QE, basically, and liquidity backstops when the stress was coming. And we used also very much the language, the communication, the signaling communication, which we called, forward guidance. And I'll give you just one example, which was still taken which was still used in the COVID shock. The governing council was giving messages such as the one I have here, that the central bank wants to ensure easy financial conditions in all jurisdictions of the euro area, or to ensure, ample liquidity. In my time, these are the words, before we were not so confident in using, saying, because ensuring easy conditions when you have a big shock, it's like a put option that you give, of course. And so you have to use that in a very careful way. And I remember in my time, that's something I was always very reluctant to use. We would, have intentions to do, we would have expectations, but we were very careful about, giving such guarantees now. And so the consequence of all that, of course, is that you have, in all this period of sometimes very bold and very strong guidance, you have to see, when you want to stimulate the risk appetite, you have to see, if people really believe you, how over this 10-year period, the whole financial system, has adapted to that sort of expectation worlds. And now you have a regime change. And so let's discuss that in the next one. So now we have I think, a very different environment, because now the central bank basically has no really problems of instruments. You know, you have the interest rates, that's the classical instruments when you have inflationary pressures. The problem is the calibration of these pressures, you know, and basically what you have now is elevated risk of adverse debt dynamics, and you have tense liquidity conditions in many markets today, especially in government bond markets, which is, you know, something very unusual. So assessing financial vulnerability, I think at this stage is very important. And we have the financial stability reviews, we have the stress testing, not so many war games. I think there are some war games for cyber attacks, you know, in infrastructures. I don't think there are really war games testing, you know, the crisis resolution mechanism. I'm not very aware what the, resolution authority, European Resolution Authority is doing. But in my time, you know, before I went to the ECB, we started with war games, you know, to test, you know, our system. So that's something I would like to know more. But the financial stability review, and the next one will come in the coming days from the ECB, gives a relatively reassuring message about the situation of the banking sector, but not so much about the non-bank, you know, financial sector, part of the economy as we know. This has been a problem in the UK, for example. So there is information in the financial stability reviews. I would say personally, until recently, we'll see the next one, I haven't seen it, but basically gave a relatively reassuring view about the environment. For example, looking at all the indicators, for example, I don't know, the degree of leverage of the non-financial corporations, the degree of profitability, are there many zombie firms or not zombie firms, the degree of capitalization, resiliency of the banking sector, etc. Even in terms of public finance, in terms of debt sustainability, the tone that you have largely sort of reassuring. And that's, again, what we have to discuss. I think the high risk of policy mistakes, and I just give a quote from Christine Lagarde a few days ago. She was saying that by itself, a mild recession would not be enough to bring down current inflation levels. So you could read that in different ways, but you could one way of reading that was basically to say, well, if you want to bring inflation down, what you need is a recession, and not a mild recession. And that, of course, would have consequences on bankruptcies. And if you believe that the risk channel of the central bank, and then under COVID, all the policies that have been taken have and the low interest rate environment that you had during 10 years has led, you know, many firms to think, or governments to think, that you are going to continue with that sort of environment, then a radical change of environment of interest rate and growth would make it very difficult, actually. And that's what the European Banking Authority is going to try to test, you know, and the next text is being organized now, but the results would come only by mid of next year. So there are two basically uncertainties, and then we finalize with the next slide. The two major uncertainties. One is the output gap. It's a classical problem. You know, you have the production capacity which may have been reduced. And the other issue is the fiscal stance. As we know, the governments are relatively generous in trying to, you know, to smoothen the energy shock today. And the combination of the two leads to big question marks about what is the output gap today. So that's one source of mistake. It's a classical source of mistake, but which is much more difficult, I would say, even than what we have seen in previous episodes. The second one, which is the topic of today, is financial vulnerability and the effectiveness of the crisis management framework. Now, if you get it wrong at the central bank, so suppose the tightening process goes on, the risk of financial amplification is really the issue now that we have to keep in mind, because if there is a lot of financial vulnerability in the system, a small increase of rates can lead, you know, to a big amplification in terms of financial conditions in general. And that's where we have to focus in the coming months. There is a very interesting paper I mentioned here. So the difference, there has been a lot of talk about what is the normal or the natural rate of interest. You know, is it 2%? Is it between 1 or 2%? Whatever. I don't think I attach a lot of importance to that. In the paper I mentioned here, there is a concept of R stars, basically by saying what may look, you know, as a neutral rate in terms of bringing aggregate demand and supply, you know, in equilibrium. What is an equilibrium rate? It's not necessarily the rate at which you will have financial stability. We had that discussion, you know, before already the financial crisis. Price stability is not enough. You also have to look at, you know, the building up of financial imbalances over time. So if you have financial implications, all this discussion about the lags in monetary policy transmission will be different. You know, we talk about long and variable lags. But when you have financial stability problems, the lags are very often very, very short and the impact on the economy very brutal. And we talk about non-linearities. When you look at the ECB accounts, the minutes, you have very little information about how financial stability consideration intervene in monetary policy decision-making. And that was, however, one of the points of the strategic review of the ECB was to say we have to bring that in our monetary policy deliberation. Maybe it's in today, I don't know, but it's not, certainly not in the accounts, and there's not much in the accounts. I can understand why, but I mean, it's not in. So the last one, yes, there have been two warnings, one from the European Systemic Board and one from the chair of the European Banking, the ECB Banking Supervisor, Andrea Enria. The European Systemic Risk Board is the macroprudential, you know, body that we have in Europe. Talks about the risk in the non-banking financial sector, but they just, you know, say, we have warned, you know, we don't have the tools, you know, we don't have the ability to address financial stability risk, you know, and it's very, very urgent. So I'm not very reassured, I tell you, when I read this warning from the ESRB, where they say there is a big risk, you know, we are worried, but we don't have the tools, you know, to address this. And the other is the banking supervisor, Andrea Enria. And he says, well, when I talk to the banks, actually, they are reluctant to have serious discussion about, you know, downside risk. You know, banks are doing better, interest rates are going up. For the short term, it's good for the banks. And he says the root cause of this attitude is that when the COVID shock came, we are so afraid about bankruptcies. So we alerted the banks, you know, that bankruptcies would go up, and actually they went down. But they went down basically because state intervention, you know, to backstop, you know, the whole system, the whole private sector, actually. So the last one now, and then we can go in the discussion. So well, my summary is monetary policy is walking on thin ice. So you can think and reflect a lot about thin ice. There are many stories about this, you know. Thin ice is okay if you go alone, maybe, but if everybody goes in the same direction, you know, it may not be the same. So if all central banks go in the same direction, it may be a bit too much. This is one of the discussions we have internationally, and that was, you know, in the last IMF discussion. But there are many other things you can discuss, you know, walking on thin ice. So bringing inflation down, you have the two principles. One is the Brainard's principle of gradualism. You know, when there's uncertainty, you act by relatively small steps, then you observe what happens and you continue, which in some circumstances is, I think, the best policy. In other circumstances, you know, when the central bank doesn't have much credibility, or when you have high inflation, you may need to act quickly. And I put a contrast between Isabel Schnabel, one member of the board of the ECB, saying that we have to act quickly. The official communication of the ECB, we have to act in a timely way, which is, you know, between gradualism and speed, and orderly. It means. And so there is also what came recently is the separation principle, which is a principle that Jean-Claude Trichet came in 2010 by basically saying we need to tighten because inflation is too high, because it's persistent, because inflation expectations are at risk of the anchoring. So we have to tighten, but at the same time, we are not sure, you know, about the strength of, you know, the financial strength, you know, of the economy in general. And so we have to be ready to come with liquidity backstops. We had that in 2010-11, the separation principle. So the central bank increased the rates, you remember, increased the rates, but at the same time was very generous in providing liquidity. Right. The basic analysis was that the banks were, in good shape, but there was a liquidity problem because nobody in the markets knew that the European banks were not in the same situation as the US banks, which were thought, at that time in much more trouble than European banks. And Nicolas, you came, by the way, with your study about triage by saying, that the credit, impairments were much higher than what were, officially declared by authorities in general. But that was a mood, and that was a mistake, I think, in policy by saying, we tighten policy because the fundamentals in terms of credit risk and all that are not that bad. And so we provide liquidity so that the banks can, roll over actually the bad loans that they have on the asset side of the balance sheet. Are we in the same situation today? I don't think so. We have much more granular information. But as I told you before in the introduction, I'm not so sure. And that's the conversation, the difficult conversation between the supervisors and the banks. And the next, so we have a promise of liquidity backstops, but we don't know the implication of liquidity. Well, how is it used in practice? So I mentioned the transmission protection instrument. Right. Basically, the idea is for unwarranted, disorderly market dynamics. And the ECB makes this difference between the two. But I think the stance, the monetary policy stance is unique. For example, if you say, I'm going to tighten, but at the same time, I provide a sort of put options for the extreme. So I have a backstop for the extreme. It influences, of course, the risk behavior of the system, and your financial conditions may not tighten sufficiently when you tighten your monetary policy. And that's a very, very difficult thing for the ECB. I think the ECB should basically focus on the whole information it has on financial conditions. But when you give promises to intervene if there are disorderly backstops, if market believes that, of course, then of course it has an influence on financial conditions. If they don't believe that, and that's the difficulty, you switch to another regime, of course.
Right.
And that's a little bit what I fear in the present circumstance. So I don't have conclusions here. I'm relatively reassured about the framework. I think the framework is much more solid than before, also because, the biggest banks are supervised. On the other hand, I'm not so reassured, by the fundamentals, the financial fragility fundamentals, and the non-bank, of course, financial system. And that could also, be extended to the public sector, of course, where, financial fragilities and the public sectors are prevailing, of course, now. And the governments cannot take all the risk, on their side.
Fantastic. Guntram?
Well, thanks, Nicolas. It's so good to be in this room. And thank you, Peter, for the very interesting presentation. Lots of topics raised. I think it's impossible in 5 minutes to react to even just a subset of what you raised. But what I thought I would do is basically talk about, make three points. I mean, the first point is when I thought about sort of what are the big financial risks on the horizon, I would say the first thing that comes to my mind is really, and I think you mentioned it en passant, is what I would call hybrid risks and cyber risks in the current situation. I mean, we are under in a situation where Russia is waging a war against Ukraine, but de facto the hybrid war at least has started. We've seen pipelines being exploded. We've seen the trains in the north of Germany being incapacitated for basically a full day due to probably an attack. And we've seen that, of course, our energy system has been very strongly switched in a very short period of time from a huge supplier which is Russia, to now a variety of sources, but one central source for gas supply to Germany has become Norway. And Norway, while Norway itself is a safe actor, there is a pipeline that basically delivers most of that gas. And we know that hybrid threats against such pipelines are very real threats. And if ever such a threat arises, that would have very strong and very significant effects on gas supply for quite a period of time. And that has, of course, then consequences through the entire economic system. The recession would be certainly much deeper. Economic activity would have to slow down, and consequently you would have, via the bank loan books, etc., quite some financial stability risks coming out. So I take these risks actually very seriously. And back in a study a few years ago that I wrote for the informal meeting of EU finance ministers, we were in fact sort of simulating and discussing what a hybrid attack would mean for the financial system and the European financial system. And sort of one conclusion was that institutionally, Europe is actually quite badly prepared for that, because while the banking supervision side and a lot of financial supervisory side are quite unified at the European level, that is not the case for the security discussion, which means that individual hybrid attacks are often very difficult to identify and very difficult to trace down, and very difficult to apply the proper measures to keep the stability of the system really up. And I don't think Europe has really advanced a lot in sort of its infrastructure to deal with hybrid and cyber threats. So that's my first point. My second point is more on the macro side. When you talked about stagflationary pressures, I was thinking, well, I mean, how worried am I, and how much will that continue? And there, I mean, there's basically two big discussions here. One is the energy side, and you know, for the energy system, sort of, if things go well, I would probably argue that things will not be easy in the next 1 or 2 years. But I would also argue that the biggest part of the shock is probably behind us, because we managed to really reshape the energy system quite a bit and find new supplies. And sort of the inflationary pressure is not going to be additional inflationary pressure. I mean, we've seen the price increases. Now the price increases have actually reversed. Now we even see some negative prices again for gas, because the gas storages are full. But I don't see sort of a big new shock coming from inflation. It's the delta is going to be more moderate in the future. The other big point on the stagflationary issues is basically the way we deal with globalization and value chains and manage risks in global value chains. And there, you know, many commentators are already sort of announcing the end of globalization and all of that. But if you look at the numbers, you don't see that, right? I mean, so you see that actually trade is picking up. It's picking up between the US and China. It's picking up between Europe and China. So you would say, well, basically there are some forces reversing also that sort of putting pressure on prices. But of course, that is always under the assumption of no further escalation of geopolitical tensions, be that around Taiwan or be that around an escalation in the conflict around Ukraine. So there, I would say the headwinds aren't there, but there are risks. Now, the third, and you know, I'm trying to stick to my allocated 5 minutes. The third point I would raise is, and you raised that as well, Peter, is around sort of the question of the fiscal and monetary policy mix. And I guess there it's useful to think for a second about the differences between the United States and the European Union. I think in the United States, you clearly had a too expansionary fiscal policy. And the consensus now has shifted in the US very much on a tight monetary policy, while the fiscal is probably a little bit, could be tighter than they for the next couple of years than they plan to do it. So basically you end up with a mix with a relatively restrictive monetary policy. And of course, what that means is that the US dollar tends to appreciate. And so in Europe, the picture is different. In Europe, the picture is different in the sense that it's much more driven by a negative supply shock, the inflation shock, not the fiscal demand shock, but more the negative supply shock. And the response has been somewhat more moderate on the monetary side, and on the fiscal side, I think it's basically all extremely. I mean, the fiscal is always political, but this time it's a sort of the distributional questions that arise out of the energy price shock are so significant that basically governments use a lot of fiscal space to cushion that, and so the tendency will be to actually continue use quite a bit of the fiscal side and relatively moderate monetary reaction. So the end result being a relatively strong appreciation of the dollar. And so what does that typically mean? Well, it could mean fiscal and other credit risks in emerging economies. And therefore, broader risks to the global financial system. So these would be, I guess, my three big points as a frame of how I think of the current sort of financial risks out there. Thank you.
Great. So we already have a number of questions from the audience, but let me start with a number of questions of my own, because we obviously have a very broad theme for today's session. It's a bit of, it's about everything through the lens of financial sector risk. There are two issues which you didn't mention, and which I expected at least one of you to mention. So let me tease you on those two. One is property markets in Europe specifically, because there have been a number of discussions about this, of course, very differentiated depending on which geography you're looking at, but generally speaking, the risk associated with the real estate downturn. And the other one is energy market instability. Guntram, you mentioned energy prices in terms of inflation, but what you didn't mention is the episode we had at the end of the summer, where there were margin calls on energy companies. Uniper in Germany had to be bailed out at enormous public cost. So is there a specific financial stability risk in the commodities and energy markets, or do you think this episode in the end was short-lived and not something much to worry about? So on those two issues, maybe Peter first and then Guntram.
Well, during 10 years, the central bank tries to stimulate the risk channel. And so, of course, there has been a big discussion.
And just for those of us not used to central banking jargon, by this you mean incentivize people to take risks, right?
Well, yes. I mean, you promise you're going to keep the rates low for a long period of time, that you're going to provide backstop, liquidity backstop, if things go bad. And so that means that, asset prices will be still, and you use, of course, your big asset prices, big asset purchases, to push the whole interest rate structure down. And so one of the consequences, which has been widely discussed, is maybe central banks did too much, and asset prices have been pushed, to very high levels. And when the conditions will change, there will be a big adjustment. I mean, and certainly in real estate, I think you're totally right. I mean, the first candidate, if the central bank has to really tighten policy, because now I don't think there is a big tightening yet. But when the central bank says, we need to do, a mild recession will not be sufficient, that means you have to increase the rates perhaps more than what many people think in the markets. And in some of the countries, when you have floating, mortgage rates, then of course the adjustment can, if you see Sweden, for example, which is not in the monetary union, the adjustment of house prices is there and quite impressive. So the lags, that economists talk, it will take time. I'm not always convinced that it takes time. The question about amplification is to see are the banks, the banking sector, sufficiently provisioned, to face a real estate crisis. The answer we get from financial stability reviews is yes. Usually they give a relatively good, signals in terms of resiliency to a real estate shock. So not only in the residential, but in the other aspect. But that's the same for the whole economic structure. You see, is there going to be a big asset price correction? Is there too much leverage in the system? In general, low rates for a long time. Are there many zombie firms? No is the test, of course. If Guntram is right, I think that's a very possibility when he says, I see the system as a two-sided risk. There are tails on both sides. There are very negative tails, of course, very pessimistic tails, as you mentioned, with cyber attacks and other, which I think is bigger than the other one. But there's also a positive outcome, which is not totally impossible. But and that's a little bit the problem you have in markets. So under uncertainty, I would say basically that the outlook for the economy is not that good. You may say, if we are lucky, we can have the good outcome. But the bad outcome, would be first terrible. And so I think, when I talk about stagflationary pressures, I think these risks are very high. And we see, economy is losing momentum very rapidly, actually. Inflation perhaps will peak.
What about the energy and commodities markets?
Well,
how did you look at that episode?
Well, I saw, of course, the issue there is first, it's market functioning in general. So one has focused on the traditional markets. And so you see also, that was a Guntram point, is that our financial stability framework is too narrow. I don't know the specifics today, but I think he has a very excellent point, is that cyber, I'm used to that. I was used with SWIFT, and other infrastructure. So we did these sort of things. But you're right. There are fragilities in the system, and the market is not only the market for basically equities and bonds and all that. It's also commodities, and we have underestimated that issue. But I don't know what's the financial stability risk now. It's flagged by the macroprudential authorities. That's for sure. But you have a good point, Guntram, on this.
Yeah, perhaps just 2 points. On the property market, I guess a lot depends on whether you think, as Peter, you were just saying, that rates are going to be hiked much, much more, or basically, as far as I understand, there's also some feeling that perhaps in Europe the hiking shouldn't be exaggerated at this stage. Now that's different scenarios, right? So if you have a much bigger rate hike, of course, then there will be stronger corrections of asset prices. I guess my feeling is, and they are just focusing a bit more on the German market. The German real estate market was very much driven not so much by loans, but actually by a lot of people using their savings and investing in property, and so basically cash for property. And the reality is that when you are in a situation where inflation is running at 10%. Or 8% or whatever it is, and might continue for another year or two. There's very few people that will actually go out of property, right? Real estate property, because where do you put it? You can't put it in stocks, because stocks are actually also very much correcting. So I think the correction in the property market in Germany, at least, I think will be relatively moderate. But
you have real estate firms. It's not only households. As you know, a big part of the property market in Germany is under companies.
That's right. But don't forget, there's another factor that will drive the property market, is that basically 1 million refugees from Ukraine that arrived this year. Since the start of the war, and so on and so forth. So the demand for housing is actually also pretty much increasing. Let me say one word on the energy instability and so on and so forth. Yes, so there were some cases with Uniper, etc. There, I think the government clearly had to intervene, because it's really public good. And if they hadn't intervened, there would have been really significant energy delivery problems for households. And so for these kind of companies, I would always see the government being ready to intervene. And so in that sense, I think the volatility has been very big in the energy prices. Now it's coming down. I think there can be new routes of volatility depending on the energy supply situation, but really also on how cold the winter is. And so that volatility matters, but we've really gone through a huge volatility shock on the energy side. So why would the next one be much worse? I mean, that I don't really see.
Peter, there's one aspect that Guntram emphasized, on which I would also like to have your reaction, which is emerging markets. The IMF, of course, has sounded the alarm. You have mentioned the fact that if many people, walk on thin ice, that's a bit of an illusion, or at least I took it to be to what Maury Obstfeld and others have been warning against in terms of the global effects of raising rates and monetary policy tightening. So can you give us a sense of where you see the Eurozone here? Is the Eurozone exposed to emerging market risk? How much should we worry about this compared to other factors in the environment?
No, that's a good point. The good point, because well, I may be wrong, but my reading of financial stability reviews is that this is not flagged, as a big issue. It's part of the international context. I would just say one thing that continues to worry me when we talk about financial stability in the global context, Nicolas, is the sort of interconnected, global financial system, because we talk a lot of fragmentation, but still, I mean, the system is dollar-based. So there are pockets, of dollar shortages, as you know, difficulties to get, dollar funding, and that's the case of many developing economies. So they are, from the European point of view, I don't see the same sort of discussions that we had in 2000, and I joined in 2011, the ECB, and we had this problem of dollar funding of many international European banks, which were lending everywhere in the world. I think they retrenched very much. And if you ask me the question today, I would be much more worried about, let's say, a financial stability risk related to a change of monetary policy in Japan, because, many of the Japanese, the search for yield went into, a lot of assets in the world, but also US dollar assets mostly, with a lot of hedges. And so a change of policy in Japan is something that put very high in my worries, but not so much, the emerging markets, as it was in 2011 and 12 for European banks. But I may be wrong, but that hasn't been flagged by ESRB, the macroprudential authority. I haven't seen that really as a major. It's part of the global environment, but not a.
Sorry, maybe they should flag Japan then.
I don't know, but I think I know since years, when you had a lot of carry trade, so that's been unwound, with the change of policy. I know there's a lot of happening. I read recently the Financial Stability Review of Japan, the Central Bank of Japan. It's a lot of information there, so I have to digest that. But my worry still remains if there is a big change of policy. This is the last central bank, being in a very accommodative mood. And so the day they will have to change their policy, if they change, they will have to change, I think. This could be a big shock, and I think that the system is preparing for that possibility. I mean, but I'm still not reassured on that side.
So you became more worried after reading the Financial Stability Report of Japan than you were before. This is not reassuring.
I'm a bit more reassured reading the report than before. Yes,
okay.
A little bit more reassured.
Speaking like a true central banker now. Miguel Medina is asking about the UK episode, and I think we have to address this one. So there was this story about liability-driven investment. So this is not about the UK specific situation, but what lessons do you drive from this, and what's the read across, Peter?
Yes, no, I mean, for me, the first is the amazing thing that when interest rates go up, the wealth, of these defined benefit systems go up, of course, because, higher rates is good news. So you improve your solvency. And so I thought, that it would be good news for the defined benefit scheme. So that was my first reactions when the shock came. Now, the second reaction was a report, I chaired a group in the BIS many years ago, where we were looking at this issue many years ago. And basically because of the accounting change, as Nicolas, the accounting rules pretty well, but when we change that, and they have to match, assets, liabilities, and in many countries, they were a double problem. One is that you don't find, the duration, on the asset side, compared to your liabilities. So that's one problem. UK was lesser of a problem. So that was my surprise. I said, well, usually they're in a better shape, in terms of asset liabilities. But the problem, of course, is the return that you have. So everybody knew in supervision, everybody knew, that they were using leverage to get a bit more return. And especially for those who don't have long-term bonds, to try to match your duration. And but I was surprised by the speed at which it happened. And these are the sort of episodes where you lose confidence, of course, in the crisis management framework. You say, we knew it before, the SRB flags these sort of issues before the Bank of England. So that's one set of remarks. We knew these issues, but they had not been solved. And the knowledge of leverage, you can read all the documents from the FSB. The knowledge of leverage is still very imperfect. The synthetic leverage essentially is still very imperfect. To have a consolidated.
Basically, if I hear you correctly, you make it boil down to supervisory failure, right?
To the what? To the?
You summarize it as a supervisory failure in the UK, or did I misunderstand?
I think it's broader than the UK. I think it's broader than absolutely. I think it's broader than the UK. And then the central bank came with the separation problem. We continue to tighten, but we provide backstop, liquidities for market functioning. And basically they explain, they were stress tests, but they were not severe enough, huge increase of rates, etc., etc.
But Peter, I can't resist also pointing out that this was really a huge political credibility problem also on some level, right?
Sure.
I mean,
the origin of the shock. The
origin of the shock. I mean, the fact that you have a government that thinks that basically it is not only a supplier of a safe asset and realizes that in fact the UK is not anymore and British pound sterling is not anymore such an asset that everybody just wants to hold because it's pound sterling, I think is a broader loss of credibility that is behind here, and where the United Kingdom really, also because of Brexit and the loss of its trading relations, really has a material loss in wealth and has not come to grips, especially the political system, has not come to grips understanding that it is...
but I wanted to add that you did it very well, the origin of the shock then, of course.
That's right.
But I wanted to add also the discussion, which I found very interesting, about dominance. Who has won, So first the Bank of England was very much criticized to give in, and then it changed, as you know. And so you have monetary dominance. Who has the credibility? I get a lot of questions actually on this. Is the central bank more credible than before? And because the fiscal authorities.
Is the Bank of England more credible than before?
I'm very careful in these things. That's why I talk more technically. I say. What scares me, Guntram is a good point, of course, the origin of the shock. But whatever the politics, you say that the shock may be cyber, maybe hybrid attack you mentioned before. My preoccupation is to say, are we prepared for that? Not so much to discuss, who is right, who is wrong in this case, but it is true when I talk about the risk of policy mistakes from the side of central banks. When a central bank says, a recession, a mild recession will not be enough, this is politically extremely dangerous, of course, because people would say, if we have a recession here, you need a recession, a good recession, to get your objective. So these questions about monetary, fiscal, political dominance, I would call it political dominance. When you have a war, normally you get political dominance. You see, when you have a war, a real war, we are not at war, of course, but
right. There's a question from Fabio Basaglia on the inflation target, and that's an old debate, but which is under a new light, I guess. Should the ECB keep it at 2%?
I think it's 2% in the medium term. So for me, I have no doubt. The question is the speed, Fabio. When I mentioned the Brainerd principle, I think that's a little bit the discussion. How gradual should you be? This is, you can have mistakes on both sides. If you think, which is the case today, unfortunately, the shock is huge. So that means the pass-through, there are many firms, being in relatively good shape. And, because when inflation is close to 10%, if you increase your prices, there is always a pass-through because, the price signaling is blurred. And so many firms, have opportunistic views, they say, oh, well, I can increase a little bit my price. Nobody will notice in that sort of context. Because when you have 10% inflation, when you have 2% inflation, it's much more visible. When price increases are high, there are a lot of things which happen in terms of, opacity of price behavior. And I think, unfortunately, in that debate, the hawks, if I can qualify them, the hawks in the governing council, it's more to say, we need, to act quickly because, the inflation is much too high. And then, of course, you have the downside of that, of course, do you really need a recession? If oil prices go down, even stabilize, and you don't have too much wage pass through, you can just get it right, as Guntram is saying. But the risk of a mistake, is quite high because Guntram, you mentioned many things that can happen. And if I would be very careful in general. So the savings rate has gone up. And at some point, you get in sort of deflationary risk, I would not call it spiral yet, but it's a possibility. So I prefer to talk about pressures, stagflationary pressures, than really stagflation. We are not yet there. But we have, severe pressures, and they could materialize very easily. And then we have to see, are below J, in public finance, just to go with the Guntram's point. I think, in my time, the governments were saying, and the COVID, you remember, interest rates will be low for a very long time. So, if I do, fiscal expansion, it will be, relatively easy. That has changed.
So I would just make a quick point of principle. I think it's always a bad idea to discuss the inflation target when you don't fulfill it, because that is typically what you're doing is you are basically at that stage really changing expectations, right? And so and saying you're not serious about what you want to achieve. And I think in the current situation, talking about an increase in the inflation target would mean that inflation expectations would much more quickly get de-anchored and wage settlements.
But Guntram, the point is the speed, the speed at which you want to
but I take you, I understand.
So that's a question, that's a question to Guntram, actually. Do you think Isabel Schnabel is right to advocate a quick return to the target?
I think it was important that she sent that signal of being more hawkish on the committee. Let me put it this way, because clearly the hawkish voice was missing when I think back about at the beginning of this year. She really played a useful role. Anchoring, I think, the overall expectations and the overall management in the ECB. So I thought
we'll not come to probably
quickly became timely. Yeah.
Yes. Familiar debates here. Victor Sebeck is asking Peter again to elaborate on bad debt, and it was a striking leitmotif of your presentation, if I can put it that way. The point about low levels of bankruptcies and bad debt. So, the questions that Victor is asking is, will governments keep finding novel ways to keep defaults low, or is there a point where it's easier to let some destruction of debt, but to reduce systemic pressures in the financial market? How do you see that in the near term?
You mean non-financial corporation debt, basically?
Yep.
Yes. You see, before, and you mentioned Isabel Schnabel, Guntram, she had also a paper about the zombies. You know, before we had this inflation shock, she was arguing that, you know, this idea that there would be many zombie firms was actually not was not widespread, actually, and so that, you know, all this accommodative policy basically was good. She supported before that shock. So I don't know. What I know is that we have much more granular information on loans, you know, to NFC. So the information that one has today is much better than what we had before. So I think, from what I read and hear, is that in the stress test framework, there is much more information about, you know, the situation of debt fragility of the NFCs. So this is one point. The other point is that
and of course, sorry to interrupt, Peter, but when you say NFC, it's for non-financial corporations.
Yes, and non-financial corporation. Now, this being said, there have been, you know, the bankruptcies really collapsed, you know, during the COVID shock. So this is probably the other part of, that's more the bad news. That means that probably with a lot of government guarantees, as you know, very generous government guarantees, the idea was, of course, that the economy would recover and then you go back to normality and things would settle. And there, I don't know, I must say, I really keen in looking for the ECB stress test, you know, of the banking sector. Right. I know that they are starting to be worried, of course, because if you have higher rates, and we look at the also the lending conditions, the standards for lending, as you know, they are beginning to tighten from the side of the banks, and they're going to tighten. And that's what I called, Guntram, the amplification factors. Right. You can tighten quickly your monetary policy, which in a way is fine. But if you get a big tightening via the lending channel, then of course you have to be careful ex ante before you do that, and that's why that's where the mistakes can be done.
And you referred to the speech in Vienna by Andrea Enria at the beginning of October, which I think was a very nuanced.
Absolutely right, absolutely right to be concerned. And I gave a quote from his speech, you see, where he says, well, the banks are happy now because, you know, interest rates are normalizing and still they don't see many bankruptcies now. And
we're almost at the hour. I want to finish with a question from Jörg Genner, who is quoting the De La Rosière report, which was in 2009, and he's kind of tongue-in-cheek because De La Rosière was analyzing the great moderation, the apparently benign conditions in the mid-2000s, and we know what happened after that. So the question is really that: Are we back to 2007? Can we look at the conditions of recent times the same way as De La Rosière was looking retrospectively at the conditions of 2005, 2006? Does that question make sense at the current context? Maybe Guntram first, and the last word to Peter.
Well, I don't know. I mean, I think we are in, if I sort of think back about in this time, I think it's really different. It's really different in so many respects. But I would find it difficult now to think what is the key issue to compare here. Perhaps the key issue to compare is the maturity of institutions, which is quite different. I mean, at that time, we didn't have all these financial stability institutions. We didn't have the single supervisory mechanism. I mean, many things were really quite fragile from an institutional point of view. And there, you know, I feel much more comfortable at the moment and much more safe. But also, on the other hand, of course, the broader context. I mean, this was still the period of great moderation, et cetera, where sort of money was easy and inflation was not a problem. And so all the issues we are raising now, they were really issues that young economists at the time weren't sort of thinking about prominently.
Peter?
I have been in all this period of exuberance in the great moderation, which for me was a period of exuberance. That's why I invested a lot in financial stability things. I mean, in the great moderation period, I don't feel the same environment that you had in the last years. But at the same time, you see, you mentioned the question of the UK, and you say, how can firms be so wrong about interest rate risk management? But central banks promised to maintain rates low for a long period of time. They promised to do many things in the forward guidance. Then the conditions change, and of course the central bank changed. And then they blame, of course, those who listen to them, So I think you need to be very careful when you make an assessment about who is doing what. I think it's very different, as Guntram is saying. At the time, when I lived this big banking crisis in Belgium with huge banks, in a small country, it's a totally different context today, because for the big banks, you have at least, integrated supervisor and information. And very intrusive, supervisors. And so I think it's quite different. Now, you never know if things turn very bad. Many banks today, like in Belgium, for example, are relatively ring-fenced. Belgium was relatively reluctant, in terms of banking union, not about the objective, but about, not going too fast, as long as you have not settled, many questions about, risk sharing, for example, and responsibilities. And so now, I know that some of these countries say, we are right, because who knows what could happen. And so the ring fencing, I think, takes, prominence again in a number of smaller countries. So it's good to have your own capital in your systemic banks today. So what are the implications, in terms of financial stability? And not necessarily bad, but in terms of what we think Europe should do in terms of banking union and capital market union for the future, this is not necessarily good. So what we see. So that's right. It's too early to tell.
And I guess a future session of this series should probably be devoted to Belgian ring fencing in the banking sector. Thank you so much. This was a very rich, very enlightening conversation. I, for one, have much clearer views on a number of those financial risk issues than I had an hour ago. We'll have the next session of the financial statement series in 2 weeks' time on November 23. We'll talk about SIPS, the Chinese payments infrastructure with Felix Chang and Emily Lin. And in the meantime, again, a warm thanks to our two speakers, Peter Praet and Guntram Wolff, for an engrossing discussion of how to think about financial stability risk in the Eurozone these days. Thanks so much.
Thank you, Nicolas.
Thank you.
Bye-bye.
Thank you. Bye-bye.
Bye.